Okay, good morning, everyone. I believe you can all hear me. Okay, good morning. I welcome you all to today's training session on financial planning and bookkeeping. So this morning we shall be looking at the act of planning our finances and bookkeeping activities. So ladies and gentlemen, at the end of this training session, it is expected that you, the participants, should be able to, one, understand financial planning activities. Two, differentiate long-term from short-term financial plans. Three, understand the reasons for bookkeeping. Four, identify bookkeeping methods. Five, record financial transactions if you can. And then six, make attempts to balance our books. I understand here some of us do not have accounting background, but in any case, it's expected that at the end of this training session, you should be able to understand how to keep your financial record, how to maintain books of accounts for your business. Let me start off by telling you that you cannot run a healthy, successful business without having your books in order. It's not possible. If your books, your financial records are not up to date, you do not keep any accounting record, it is very impossible for you to run a successful and healthy business. Any attempt to do so will be likened to a man who drives a car without a fuel gauge. And you know what happens when you drive a car without a fuel gauge. Sooner or later, you will run out of gas or fuel, as the case may be. The car will be forced to be pushed aside or towed away. So the point we're trying to make here is that financial planning is very, very important for every business to succeed, as well as bookkeeping. For you to succeed in that your business, you need to plan your finances. As well, you need to maintain your financial records. What then is financial planning? Now, why do we engage in financial planning? Financial plan is a plan needed for estimating the funds requirements of a business and determining the sources for same. So any attempt to estimate how much funds is needed for injection into your business, and having estimated the amount that is needed for that business to thrive, you also consider the sources of the fund. The act of deciding or taking those decisions, you say that you are engaged in financial planning activities. So first, you have to identify how much in terms of naira and kobo that is needed for you to establish that business of yours. Having ascertained the amount that is needed, you need to also establish where the money will come from. That's the sources of the fund. So all of these planning activities is what we refer to as financial planning. It's not just enough for you to decide that X amount of naira is needed for your business or you want to go into business. The moment you conceive that business idea, you must also establish much in terms of naira and kobo that is needed for that business to thrive. And secondly, you also need to spot or identify the sources where those money will be coming from. So all of these activities is what we refer to as financial planning activities. So it essentially includes generating a financial blueprint for your company's future activities. Here are the key objectives of financial planning. I mean, why do you, as an entrepreneur, as a businessman or woman, why do you need to engage in financial planning? Here are some of the objectives. One, ensuring availability of funds. The main reason why businesses or business owners engage in financial planning activities is to ensure that funds are readily available for that business. And two, to estimate the time and source of funds. Having identified how much is required for the business to operate efficiently, you need to also identify the time, when the funds will be needed, and the sources of the funds, where the money can be gotten from. Having done that, you decide on generating what we call a capital structure. Most funds constitute what we call debt and equity. If you're able to establish that 10 million naira, for instance, is needed for that business of yours to thrive, out of the 10 million, what proportion of it will be contributed by you, the business owner? Any amount you contribute is what we refer to as equity. And what portion out of the 10 million will have to be borrowed? Any amount that is borrowed is what we refer to as debts. So dividing all your total capital requirement between equity, that's the one contributed by the owners, and debt, the one that has to be borrowed, means you are generating a capital structure for the business. A good capital structure is so important for every business because no rational investor wants the amount of loan taken or obtained to be higher or greater than the amount the shareholders have contributed themselves. Any attempt to borrow more than what you have contributed means that the business is exposed to risk of takeover and the rest. So you have to decide on the appropriate capital structure for your business. And any attempt to decide or take such decision, say that you are planning your financial activities. Another objective of financial planning is avoiding unnecessary funds. You have to avoid unnecessary funds from being tied up in the business. If funds are not immediately needed, it makes no sense for you to borrow the funds or inject the funds into the business. You can only introduce funding into the business when they are immediately needed. Let me say here that for every money that is injected, every fund that is injected into a business, there is what we call cost of borrowing. There's always cost of borrowing, be it the loan you have taken from NISA Microfinance Bank or any money market or any finance institution. There is a cost attached to it, cost of borrowing, such as the interest you are likely to pay. So no rational investor will take up funds, borrow money, and incur interest on it when the funds are not immediately needed. Even the funds that you, the business owners, have brought into the business, there is also a cost attached to it because you, the business owner, have an option of reinvesting such fund either in a short-term investment and making little returns on them. So you have to avoid unnecessary funds from being tied up, ensuring that funds are introduced into the business when they are needed. So here are some of the objectives of financial planning, the reasons why companies and individuals engage in financial planning activities. So for financial planning, we have two major types of financial plans. We have what we call the long-term financial plans and the short-term financial plans. The long-term financial plans is sometimes referred to as strategic financial plans. Long-term financial plans consider a number of financial activities which include, but not limited to, one, proposed fixed asset investments. So any plans by a company to acquire a fixed asset. Such plan is referred to as long-term financial plans. Let me give you an instance. Fixed asset investment, those items that belong to the entity which will be used for revenue generation. Imagine if you are into agriculture, crop cultivation, and you are considering acquiring a tractor. Tractor is a good example of fixed asset investment. So if you, the business owner, the shareholders have to sit and plan on how that tractor will be financed. Such planning activity is what we refer to as long-term financial plans, because the tractor, you will take decisions as to, should the tractor be bought outrightly? That's if you have enough cash or enough resources to buy the tractor outrightly. You go to open market, pay for it, and the tractor is delivered to you. That's one option, one decision you have to make. Another decision will be, should the tractor be purchased through finance lease, what some people know as hire purchase? I mean, should the tractor be delivered to you while you pay instrumentally? So any attempt to take this decision that borders on fixed asset investments, we say that such plan is a long-term financial plan. Also, another activities under the long-term financial plan is research and development activities, where a company wants to decide on how each product and prototypes are to be developed. Those planning activities border on long-term financial plans. Marketing and product development is also a long-term financial planning activities. Planning on how to market and develop your products. Capital structure, also any decision that borders on capital structure has to do with long-term financial plans. I already said what capital structure is. I mean, dividing the total fund requirement between equity and debt. So those decision borders on long-term financial plans. Also deciding on sources of financing. I've also explained this to you, sources of financing. I mean, if management has to take decision where the funds are to be gotten from, that's a source. Such a decision borders on long-term financial plans. So these are some of the examples or some of the long-term financial planning activities. These plans are generally supported by a series of annual budget and profit plans. So for you to attain a long-term financial plans, the plans will have to be subdivided or broken down into annual budgets and annual estimates. So, ladies and gentlemen, a good way of identifying that a plan is of a long term is when such plan addresses issues that will linger for, say, 3 years and above. So if the time frame or the period of your planning activities will span up to 3 years and above, you sure know that such plan is a long-term financial plans. So the period of such planning can give you an indication as to the type of plan that it is. So a plan that spans for a period of 3 years and above is a long-term strategic financial plan. So the other plan is the short-term operating financial plans, meaning if a plan is not of long-term, it is definitely a short-term. Short-term financial plans specify short-term financial actions and the anticipated impact of those actions, and they typically cover a period of 1 to 2 operating period. A good example of short-term operating plans would be plans that borders on the management of your working capital, those assets that belongs to your business, your company, which can be converted to cash within 12 months. So any attempts to take decisions on how those assets or liabilities are to be managed, such plan is referred to as short-term financial plans. I give you an example. Working capital. Examples of working capital could be trade receivables. Maybe you have sold on credit and customers are indebted to you or to your company. So if you are taking decisions such as how long should you be owed by these debtors before the money is eventually paid to you, those decisions border on short-term financial plans. Maybe you are taking decision that your company will not be owed for more than 30 days. Your company should be owed for a maximum of 60 days. Those plans border on short-term financial plans. Have inventory. You're taking decisions. How long should you hold inventory? That's your stocks. Because these are working capital. Those decisions that border on the management of your working capital fall under the short-term operating financial plans. So a good way of identifying that a plan is of a short term is when you consider the period of the plan. If the period of the plan is between 1 to 2 years, you know that such plan is a short-term financial plan. So ladies and gentlemen, take note. If a plan is not a long-term plan, it is definitely a short-term plan. There are various tools available to companies or business owners in planning their finances. Act of financial planning, you have various tools that can help you achieve that financial planning activity. And one of the most important tools for planning your finances is what we call cash budget. We use cash budget as a tool for planning our finances. What then is a cash budget? Cash budget is a statement of a firm's planned inflows and outflows of cash. A cash budget, any statement that itemizes the total inflow of a firm and the outflows of the same firm is what we refer to as cash budget. Inflow, I mean all the sales, cash sales that you are to generate for a particular period. And all the total outflow, that's the payments, cash payments that you are to make for a particular period as well. So in drawing up a cash budget, summarize all the income, all the sales, cash sales that will be generated, and you minus all the payments that will be made for that same period. So the cash budget is used to estimate short-term cash requirements with particular attention to anticipated cash surpluses and shortfall. Cash flow statement is used for ascertaining how liquid your company is. If you want to know if your company is liquid enough or not, you have to use what we call cash budget statement to prepare cash budget statements. Because if a company is liquid enough, it shows that the company has enough resources, enough cash and cash equivalent to meet up with short-term debt when creditors or suppliers, vendors, as the case may be, come knocking, asking for payments. So every rational businessman or woman will want to guarantee a surplus cash budget, meaning that you have generated enough cash that you have spent. So the more reason why we have to plan our budget also is to help us guard against unnecessary spending, such that if what has not been included in the budget comes up, you assess if such expenditure is necessary or not for the business. And if they are not necessary, you try as much as possible to guard against it in order that you maintain a healthy and liquidity position. So typically, monthly budgets are developed covering a 1 year time period. So in order for you to draw up your cash budgets, it's expected that you draw them monthly, and from monthly you translate them to annual cash budgets. That is a typical example of budget cycle. The If you want to engage in budgeting activities, here is a typical example of budget cycle. First, you have to engage in performance planning. You plan your performance. Performance planning is that act of deciding on the goal or objective of the business. You have to decide on the goal of your business. I'll give you an instance. You are considering going into farming, and you said, okay, your goal for this farming season is that you want to have at least 10 tons of maize. Maybe perhaps you want to plant maize. You say, okay, after the planting season, I want to have 10 tons of maize from the farmland you have cultivated. That is your goal. That is your objective. And that is what we refer to as performance planning. So you have to establish a goal or objective for that business of yours. That's the first thing under budget planning. Second one is providing a frame of reference. A frame of reference means for you to benchmark your goals. It will make no sense for you to set goals or objectives that are unattainable, unrealistic. Take, for instance, you have said you want to at least have 10 tons of maize from your farmland. It has to be a benchmark such as make inquiry to establish on average how many tons can you cultivate from 1 hectare of land. If, for instance, 1 hectare of land gives you at least 2 tons, it means for you to have or attain the 10 tons of maize you anticipated, you must cultivate at least 5 hectares of land, farmland, for you to have the 10 tons that you anticipate. So that is a frame of reference, a benchmark. You are setting a benchmark to make sure that your plans, your objectives, your goals are as realistic as possible. Then you go into implementation, which is the farming activity now. And after the farming activity, you're likely to have a variation. Variation or the variance can be either favorable or unfavorable. Of course, you know when the variance is favorable. If, for instance, you said you wanted 10 tons of maize after cultivation, and perhaps you're able to record 12 tons, it means your variance is favorable. It's favorable to you because you harvested enough output than you anticipated. Or if it is negative, adverse variance, it means that the output was short of what you initially anticipated. In this case, you have to investigate the variations. Investigating variation could be inquiring for the reasons why the adverse results occurred. You probe into maybe the output you used, if you use the right seedlings, if you planted the right kind of maize, if you use the right type of fertilizer, if you planted in good time and all that. So these are investigations into variations, especially when your budget is quite different from the actual results that you have witnessed. Then the next step will be taking corrective actions. You have to take corrective actions to forestall reoccurrence of those activities that are hampered or hindered the attainment of your goal. Remember, we said the goal was for us to at least have 10 tons of maize. So at the end of the farming season, we have to take corrective actions so that the next planning activity, next budgeting activity can be favorable to us. Such corrective actions, like the example I've just said, could be ensuring that you plant a little bit on time. I mean, in the next planting season, ensuring that you use the right seedlings for the next planting, ensuring that you use the right fertilizers and farm input materials. So these are corrective actions that you can take in order to forestall the occurrence of any adverse or negative budget results. Then you go ahead and plan again. Planning is a continuous process. We plan irrespective of the results, irrespective of the outcome, we plan over and over again. So these are the typical budget cycle that you are likely to follow while planning your budgeting activity. So strategy analysis, we have two types of strategy. We have the long run strategy or plan and short run strategy or plan, like I told you earlier. So for you to attain your long run strategy, it's expected that you use long run budget. I mean, if you want to address plans that border a long period of time, you need to use a budget for 3 years and above, meaning your budget will cover a long period of time. Or if your plans are of short period, meaning that your strategy is short, it means you are to deploy or use the short-term budgets, means short-run budgets, such as monthly budgets and annual budgets, for you to address your strategy. There is what we call cycle of money, ladies and gentlemen. Cycle of money, the primary function of finance is the movement of money from lenders to borrowers and back again. This is referred to as cycle of money. Let me give you an instance. Every money, every finance that is injected into the business tends to rotate, comes into the business and it leaves the business as well. If you successfully secure the loan from National Microfinance Bank, the money is brought or injected into your business. As the money is injected into your business, you discover that the same money that comes into your business will find its way out when you begin to make payments for salaries and wages. You pay vendors and suppliers for the goods or services that they have supplied. So the money comes in through loan or through capital injection by you, the owners of the business, and the money goes out again by the time you start making payments, salaries and wages, you pay suppliers and vendors, the money goes out. Then the money comes back again by the time you have manufactured that goods or services and you have to sell the goods or services to customers. Customer will pay for it and you discover that the money finds its way back into the business. So this is what we call cycle of money. So that money tends to rotate. It rotates in and out of your business. So that's why I would say the primary function of finance is the movement of money from lenders to borrowers and back again into the business, otherwise referred to as cycle of money. So let's consider bookkeeping. Bookkeeping involves the recording on a daily basis of a company's financial transactions. So the whole essence, the whole act of trying to maintain adequate books of accounts for your business on a daily basis is what we refer to as bookkeeping. For every transaction that occurs within your business, you try to document it. You try to keep a record for it. That's what we refer to as bookkeeping. When you make purchases, you document it somewhere. That is bookkeeping. When you make sales, you document it somewhere. That is bookkeeping. When you pay vendors, document it somewhere. That is bookkeeping activity. So bookkeeping is very important for every business entity. Remember the example I gave you, the man who drives a car without a fuel gauge. If you run a business without a good or proper book of accounts in place, that business may not go far. It may not go far. It's very unhealthy for businesses to thrive, to run without adequate books of accounts. So it's expected that you are able to maintain adequate books of accounts. With proper bookkeeping, companies are able to track all information on its books to make key operating, investing, and financing decisions. You have adequate books of accounts in place, you're able to take key operating, investing, and financing decisions. Bookkeepers are individuals who manage all financial data for companies. That bookkeepers, companies will not be aware of their current financial position, as well as the transactions that occur within the company. So it's expected that you engage the services of bookkeeper who will help you with your record keeping. In any case, if you cannot afford the services of a bookkeeper, there are ways you can also maintain the books yourself. Before the end of this training session, I will show you how to maintain your books of accounts, even as non-accountants. I'll show you how to maintain your books, adequate books of accounts. Here are some of the importance of bookkeeping. These are some of the importance of bookkeeping. One, bookkeeping provides a reliable measure of a company's performance. We maintain books of accounts. We are maintaining a reliable measure of a company's performance. It's only when you maintain your books of accounts that you can measure the performance of your company. You can say for sure that your company is making enough profitability and returns. So adequate books of account will help you assess the performance of your company, if your company is doing well or not. Another importance of bookkeeping is that it provides information for strategic decision. When a company maintains adequate books of accounts, the company is able to take key strategic decisions. Let me give you an instance. If you as a business owner, you operate two segments. For instance, one of the segments you are involved in crop cultivation, and the other segment you are involved in animal cultivation. So one segment crop cultivation, the other segment animal farming. It's only when you maintain adequate books of accounts that you're able to assess which of these two segments is doing well enough. So when you have good books of account in place, you're able to tell for sure if it is the crop segment or the animal cultivation segment that is bringing enough returns to you. And those decisions will help you by probably channeling all your energy to the segment that brings adequate returns. If you discover that the crop cultivation is not doing well enough, you may take key strategic decisions by closing the crop segment and channeling all resources and time to the animal cultivation. That's what bookkeeping does. It helps you with key strategic decisions. Bookkeeping also provides benchmark for revenue and income goals. When you maintain books of accounts, you're able to provide a benchmark for your income. It gives you an idea where your revenue are to be generated from. Know the likely areas that you are to earn revenue and income, and you vigorously pursue it. That's what bookkeeping does. Another importance of bookkeeping is that it helps in the fulfillment of legal and tax obligations. When your books are in place, you maintain adequate books of accounts, you are able to Okay, so sorry for the loss of network. Okay, so we can continue now. We disabled sharing. Okay, welcome back. So sorry for the network problems. So we said fulfillment of legal and tax obligations is another importance of bookkeeping. Discover that some people are able to file their tax returns, comply with all legal obligations when they maintain their books. I give you an instance. You're a business owner. There is a law that once your business makes loss within the first 3 years of its operation, such business is exempted from tax payments. That's a tax law. Imagine in the first year, God forbid, the business, you recorded losses, you're exempted from tax payments. Second year, the same thing. Third year, the same thing. But you cannot successfully prove to the tax authority that you have recorded losses, except there are books, financial records for you to present to justify your position. So we are saying that bookkeeping is so important for the fulfillment of legal and tax obligations. Another importance is that it provides stewardship function to investors. Bookkeeping provides stewardship function to investors. Modern day businesses, you discover that investors are quite different from the managers. Those who have contributed their funds for the business to be set up differ from those who are charged with the day-to-day running and administration of the business. So for the managers who have been entrusted these businesses to provide stewardship and accountability function to the investors, they have to present their financial records. That's why bookkeeping is so important. And lastly, proper management of cash flows. It's only when you maintain your cash flow, maintain your books of accounts, that you're able to ascertain if your cash flow has been properly managed. And remember the other time I told us that a good cash flow management will entail that the business is always liquid, meaning that the business has short-term, the business has cash and cash equivalents. I mean, when debtors come knocking at the door, you're able to settle such liability when they due, meaning at least there should be something, there should be a balance, either at hand, in your hand, or in your bank account to show that you are liquid. So it's only when you maintain adequate books of accounts that you can properly manage your cash flow. So these are some of the importance of bookkeeping. Let's look at accounting basis. There are basically two bases of accounting. When we talk of basis of accounting or accounting basis, we are referring to the period of time that an accounting transaction will have to be recorded. At what period of time should the bookkeeper record a particular accounting transaction? Should it be when goods have been sold, even if the money has not been received? Or should the bookkeeper wait until the funds have been received before he books or records an accounting transaction? That's what we mean by accounting basis. So basically, we have two accounting bases. We have what we call the cash basis and the accrual basis. Let's look at the cash basis of accounting. Cash basis of accounting is an accounting basis that advocates for transactions to be recorded only when cash is received or paid. Under the cash basis of accounting, accounting transactions are only recorded when cash is received or paid. I give you an instance here. You are into buying and selling, and you have sold your goods. For the fact that you have sold your goods and your customer is promising to pay you in 1 month's time, you can only record such sales transaction in 1 month's time when the customer has made payment for those goods. So, meaning that you are operating on the cash basis. Emphasis here is on cash movement. Accounting transactions are recorded or documented only when cash comes into the business or leaves the business. So, like the scenario I gave you, you have made sales, your customer is promising to pay you in 1 month's time. For the fact that that cash has not been received by you, you cannot record that sales transaction. You rather wait until 1 month's time when the customer hands over the cash to you in payment for the goods that he or she has bought before you can record that transaction. That's what we mean by cash basis of accounting. The same thing applies to payments. If you buy goods on credit, maybe you have bought fertilizer on credit from a supplier, and you are promising the supplier that you will make payments in 2 weeks' time. Because the payment has not been made, now you discover that money has not left your business. It's only in 2 weeks' time when you make payment to the supplier, either you cut check to the supplier, the money leaves your bank account, that you can record such purchase transaction. So emphasis on the cash basis, is on cash movement. If the cash moves, you record or document that transaction. But if the cash has not moved, either in or out of the business, such transaction will have to be totally ignored. Then the other type of accounting basis is the accrual basis. Under the accrual basis, accounting transactions are recorded when they occur, even if cash is not received or paid. So under the accrual basis, accounting transactions are recorded when they occur, even if cash is not received or paid. So just like the other instance I gave you, if you sell goods on credit and the customer is promising to make payment in 1 month's time, because you are using the accrual basis, if you look at it, the transaction has occurred. For a customer to go or part away with your goods or services, it means the transaction has occurred, irrespective of the fact that you have not been paid. So for the fact that the transaction has occurred, you need to do what? To book or record that accounting transaction, not to necessarily wait until you receive the money. The same thing applies to the purchases. You have to buy fertilizer from your customer, your vendor who supplied you with fertilizer, even as you are promising to make payment in 2 weeks' time. For the fact that those fertilizers have been delivered to you, the exchange transaction has taken place, meaning that the transaction has occurred, and as such, you're expected to record such transactions. So cash basis focuses on cash movement, while the accrual basis focuses on the occurrence of the transaction. So take notes, difference between the two. Here is an example. You purchased 100 units of products and you will pay for it next month. Purchase 100 units of products and you will pay for it next month. So under the cash basis, no transaction will be recorded. Remember, payment is due next month. And for the fact that payment has not been made, cash has not exchanged hands, under the cash basis, you're expected not to record any transaction. But if you're using the accrual basis, based on this example, you have purchased 100 units of product. For the fact that those products have been delivered to you, meaning that the transaction has occurred, you're expected to do what? To record the transaction, the appropriate transaction. So ladies and gentlemen, we must take note that any of these accounting bases that is adopted have to be applied consistently. If you adopt the cash basis in your year 1 of preparing accounts, it's expected that in your year 2, year 3, and so forth, you also continue with the cash basis. You are totally forbidden from using the cash basis in 1 year and next year you switch to accrual basis. That's the point I'm trying to make. If you feel it is the cash basis that is suitable for you, it's expected that you start with the cash basis and you continue with the cash basis. If you feel it is the accrual basis that is more suitable for your business, it's expected that you start with the accrual basis and you continue with the accrual basis. It is totally against accounting principle for you, or bookkeeping principle for you to use the cash basis this year, 2020, and next year, 2021, you want to use accrual basis. No, it's totally forbidden. Any attempt to switch between this accounting basis means that your financial statement will become incomparable. You cannot compare the financial results, because financial results or your financial account you prepare using cash basis will differ slightly or greatly from the one you prepare using the accrual basis. For there to be consistency and for users of your financial statement to always compare your financial statement between 1 year and another year, you have to stick to one basis of accounting. Take note. Methods of bookkeeping. There are basically 2 methods of bookkeeping. Remember, at the beginning of this session, I told us that some of us may not have accounting background, but it's expected that at the end of this training session, you should be able to know how to keep your records, your financial records. There are 2 methods of bookkeeping. We have the single entry bookkeeping method, the double entry bookkeeping method. The single entry bookkeeping method is a straightforward method where only 1 entry is made for each transaction in the book. Just 1 entry is made. And this method is most suitable for those who do not have accounting background or accounting knowledge. How do you maintain your books? Single entry bookkeeping. Some people may have a hard cover notebook where they record all transactions that occur. You have your books where you record, oh, this for today, I have paid salaries, you record salaries in this particular column. I have made repairs and maintenance of your equipment or your asset. You book it on a particular line. You pay utility, book it on the other line. So on and so forth. These are ways of maintaining your records. Some people say, okay, I want to maintain a book. I have this notebook for recording all my sales transactions. That act is in its simplest form. Another company or another person may say, oh, for every check that I issue to my vendor, my supplier, I will have to document it on my check stub. That's a small leaf on the check booklet. You fill or populate the check stub with the information. That act is what we refer to as bookkeeping in its simplest form. That's a single entry bookkeeping method. Another person may say, oh, I want to get analysis column cash book sold in a bookshop that has various columns where every transaction, you record it, you fill it, and you place it under the right column. The first column may be salaries and wages, second column may be repairs and maintenance, third column may be utility, fourth column may be transport and travels, so on and so forth. You book it under the right column. So these are various ways, simplified ways of maintaining our books under the single entry bookkeeping. It is straightforward, and those without accounting knowledge are strongly advised to adopt the single entry bookkeeping method. Now, for the double entry bookkeeping method, double entry is more robust. It follows the principle that every transaction affects at least 2 accounts, and they are recorded as debits and credits. For example, if you sell a bag of cowpea for 20,000, even if it is one transaction, but the accounting entries will have to be double. We call it debit and credit entry. Pass the entries into debit and credit. So this double entry bookkeeping is for bookkeepers who have knowledge of accounts. If you're able to afford the services of a bookkeeper may deploy this double entry bookkeeping method. But if you do not have accounting knowledge or background, you are advised to stick to the single entry bookkeeping method. Accounting systems. Accounting systems are designed to collect, document, and report on financial transactions affecting business. Any system that is set up, that is designed by you, business owner, in order to collect, document, and report on financial transactions affecting your business, such system, we refer to it as accounting system. Accounting systems are in two ways. We have the manual accounting system and the computerized accounting system. The manual accounting systems, accounting transactions are simply processed by hand. If you have to process your accounting transaction by hand, where you have to write on your book manually for every transaction that happens, it means you are maintaining your accounting system manually. The other one is the computerized accounting system. Under this case, financial information is recorded by entering it into a computer. If you rely on the use of computer to maintain your books of accounts, it means your accounting system is computerized in nature. Maybe for every transaction that happens, you go to your system, you create Excel sheets, that's a spreadsheet, and you key in the accounting transaction in your Excel sheet. It means your accounting system is computerized. Or maybe you have to deploy an accounting software such that you can post your accounting transactions. You may have softwares like Sage, Peachtree, Tally, QuickBooks, and the rest to help you post your accounting transactions in this system. So for the fact that you are using computer to maintain this accounting information, it means that your accounting system is computerized in nature. So among the two, the question will be, which is more advisable? Of course, the computerized accounting system is more favorable than the manual accounting system. Why? Because the moment you use computer, you are sure to a certain extent that the accounting information, the financial reports to be produced will be free from error. But accounting information may not be totally free from error, even when you use computerized accounting system. The reason being that there's what we call GIGO, garbage in, garbage out. GIGO, garbage in, garbage out. You may mistakenly key in a wrong information into the system. And because you have keyed in a wrong information, it may translate to wrong financial reports being generated. So even though we say computerized accounting systems are more reliable, they are not totally they are not totally free from error. They can also be prone to error, but such error is man-made, meaning that the bookkeeper who has keyed in the information may have keyed it wrongly, resulting to what we call GIGO, garbage in, garbage out. But to a large extent, if the informations are properly keyed into the computers, the computer system tend to be more reliable than manual accounting system. Still an accounting system, that is what we call GAAP, generally accepted accounting principles. All accountants use the same set of rules to prepare financial reports. The Financial Reporting Council of Nigeria issues these rules. GAAP, generally accepted accounting principle. For you to prepare accounts, you must adhere to the rules as provided or established by the Financial Reporting Council of Nigeria. It's so important that every bookkeeper, every accountant who want to prepare account of a company must adhere to the rules and provisions of Financial Reporting Council of Nigeria. Those set of rules is what we call generally accepted accounting principle. Let me give you an instance. The reason why this set of rules must be adhered to by preparers of financial statements. You as a business owner, you may be tempted to prepare your account in a manner that results to a lower profitability for you, because a lower profitability that you have prepared will result to lower tax payments. So you may be tempted to manipulate the account such that your profitability is so little and your tax payment for that period is also very little, or so that you don't even pay taxes at all. So another user of financial statements, maybe a manager whose reward system is incentive-based, is based on the volume of profitability recorded. Discover that the manager, while preparing the account, may do everything possible to ensure that the profitability level for that period is so high in order that he or she can enjoy the incentive attached to such huge profitability level. So in a bid to guard against all of these window dressing and creative accounting, Financial Reporting Council of Nigeria then came up with a set of rules known as generally accepted accounting principles, so that all preparers of financial statements will adhere to these rules in order to safeguard and prevent what we call window dressing and creative accounting. So while you prepare your account, you must make reference to provisions of the Financial Reporting Council of Nigeria. So we have financial reports. The end product of the bookkeeping activity I encourage you to engage in, the end product is financial reports. When you keep your books of account in place, that books of account, the bookkeeping activity will translate to you generating your financial reports. That's your accounts. And financial reports are summarized information about the financial status of a business. So when your books are properly kept, it helps you to generate financial reports. Language of business. Accounting is seen to be a language of business because it is so fundamental to the communication of financial information. Accounting is often called the language of business. Accounting is the language of business because you want to track all naira and kobo that comes in and out of the business. That's why it's called the language of business. Accounting reports are subdivided into two broad categories. We have the financial accounting. Financial accounts are those accounts that focuses on reporting information to external users. Any account that is prepared, any accounting report that is prepared to serve the needs of external users is referred to as financial accounts. If you have to prepare accounts to serve the needs of those who are not members of the company, those who are not part of the company, that account is referred to as financial account, because the account is meant to address the needs of external users, non-members of the company. Any account that is prepared to address the needs of internal users, members of the company, that account is referred to as management accounts. So management account focuses on reporting information to management, often referred to as accounting for internal users of accounting information. So I want you to take note that financial accounts are prepared to serve the needs of external users, while management account is prepared to serve the needs of internal users, members of the company. So if a manager requests for an account to help him or her make or take adequate informed decision, such account handed over to the manager is referred to as management account. Or the owners of the company says, I need an account to assess, to take decision and see how the business is faring. That account prepared is referred to as management account because it is prepared for internal users' consumption. The account that is prepared for external users is what we refer to as financial account. Okay, let's see who are external users and internal users. External users are individuals outside the business who have an interest in the business. So individuals who are not members of the business, but who have interest in one way or the other in the business, they are referred to as external users. A good example is government. Sometimes you prepare your accounts, such financial reports will have to be submitted to government authority. Maybe you are involved in insurance business. You prepare your account, such account will have to be submitted to NICOM. Maybe you are involved in pension business, a PFA, pension fund administrator. When you prepare your account, it's expected that your accounts are submitted to National Pension Commission. These are government entities who have interest in your financial statements. Sometimes, even when you prepare your account, you are expected to submit it to FIRS, Federal Inland Revenue Service, so that you can be properly assessed tax. So these are examples of external users. The general public also is an example of external user. But your account can only be made available to the general public if you are a PLC. If you have your shares trading on the floor of the Nigerian Stock Exchange, that's the only way your account can be made available to the general public. Companies like Julius Berger PLC, Zenith Bank PLC, GT Bank PLC, and the rest, those PLCs, their financial statements are usually made public because they have their shares trading on the floors of the Nigerian Stock Exchange. Civil societies also may be interested in your financial statements as external users. Civil societies may demand for your financial statements for their personal consumption. Lenders, those who have provided your business with funding, they may be requesting for your financial statement. Example, if you successfully obtain the loan from NISA Microfinance Bank, NISA Microfinance Bank becomes a lender to you. So NISA Microfinance Bank will always request that you submit your financial statements to them. So these are examples of external users. Now for the internal users are individuals inside the business. Individuals inside the business. Examples of internal users are shareholders, owners of the company, they are internal users. Managers, those entrusted with the day-to-day administration and running of the business. They will also be interested in the financial reports. Employees, your staff, who are under your payroll, they will also be interested in your financial reports. So these are examples of internal users. So here are primary accounting reports. The end product of the bookkeeping activity you are expected to maintain is for you to be able to generate any of these primary accounting reports. Number one, the balance sheet. It's expected that your bookkeeping activity should help you generate balance sheets. Your bookkeeping activities will also help you generate or prepare your income statement. Bookkeeping activity should also help you prepare your cash flow statements. So these are the main accounting reports expected to be derived from our bookkeeping activity. So if you successfully keep your books of account in place, even as non-accountants, don't forget that emphasis here is on bookkeeping for you to maintain your books. As non-accountant, you may not be able to generate this report, but the moment you're able to maintain your books and keep adequate records of your financial transaction, you can hand over those books to a qualified accountant who will then prepare or draw up these accounting reports that we can see on the screen. So let's look at them one after the other. Balance sheets. Balance sheet is a statement that shows what you have and what you owe to outsiders. So any statement of a company that shows how much a company has in terms of assets and what the company owes to outsiders in terms of liability or indebtedness, that statement is referred to as a balance sheet. So balance sheets, we have assets, liabilities, and equities making up balance sheet. I will show you example of balance sheets in our next session, in our next slide. I'll show you example of balance sheet in our next slide. So that's what we call balance sheet equation. Asset is equal to equities and liabilities put together. So when you add equities and liabilities together, you must equal the value of assets. Then income statement. Income statement is also another accounting report that you will generate from your bookkeeping activity. Income statement. Income statement is a statement that is prepared to show how much in terms of profitability that a company has recorded. Prepare income statements to showcase the profit level, profitability that a company has recorded. That's why we prepare income statement. So in preparing income statement, basically aggregate all sales, deduct expenses, then you have either profit or loss. That's for the income statement. And the third type of statement is the cash flow statement. The cash flow statement is likened to the cash budget, only that this one is based on actual results. Cash flow statement. Cash flow statement is a statement that is prepared to show the liquidity position of a company. We prepare cash flow statements to assess how liquid a company is. And remember we said liquidity means ability of a company to meet up with short-term debts when they fall due. So if you want to test your liquidity of a company, we want to see if you can meet up with short-term debts when they fall due, when your debtors come asking for their payments. Can you quickly settle those debts? Can you quickly make those payments? That's what we mean by liquidity. So we must know that liquidity is different from profitability. Liquidity is quite different from profitability. So in preparing cash flow statement, we aggregate all the cash inflows and we deduct cash outflows. leaving us with what we call cash and cash equivalents. So cash inflow, all the sales generation, all the sales you have generated for a particular period, the cash sales you have generated for a particular period, that's your cash inflow. Then you minus all the cash payments you have made for the same period. So it's expected to leave you with a surplus. Either surplus or deficit. And like I told us earlier, a rational business investor will always want to maintain a surplus cash budget, meaning that all you have generated for the period is greater than all you have incurred or expended for that same period for you to be liquid. So here is a balance sheet equation. Assets must be equal to liability and equity put together. Equity and liability must equal the value of your assets. Equity and liability put together must equal the value of your assets. Income statements. To prepare income statement, you basically aggregate all revenue. Then we deduct all expenditure. Total revenue minus expenditure will leave us with profits. Total revenue minus expenses leaves us with profit or loss. But in the other case, if expenditure is greater than the revenue, it will leave us with loss. So we must always strive to ensure that total revenue in terms of total sales is always greater than expenditure for us to record a good profitability level. So here is an example of a balance sheet. Here's a typical format of a balance sheet before us. You can see on the left column, we have assets, and on the right column, we have the liabilities and equity. Let's start from the assets. Assets are items or resources owned by the company, which will be used for revenue generation. Sometimes we say for future, to generate what we call future economic benefits. Any asset, any item you have in your possession that will help you to earn revenue, to earn sales, to earn income, such item is referred to as an asset in the company. So assets are categorized into two broad categories. We have the current assets and the non-current assets. Current assets and non-current assets. Current assets are those items belonging to a business entity which can be converted to cash within 12 months. So when you have any item that belongs to you, that belongs to your business, that belongs to your company, which can be translated or converted to cash within 12 months, such item is referred to as current assets. Examples of current assets, we have accounts receivable, that's debtors. When you sell on credit, the amount that is due to you from customers is what we refer to as accounts receivable. For the fact that you expect such amounts to be paid by the debtors within 12 months, we have to classify it under current assets. Inventory. Inventory, another name for inventory is stock. Those items you have for your business, which is meant for resale, is what we refer to as stock. So when you have items that you are holding for resale, take for instance, your crops you have harvested, you are holding it in a warehouse and you intend to sell them. Such stock, such farm produce is referred to as inventory. And because you expect to sell the inventory within 12 months, it is classified as current assets. Prepaid expenses. Expenses, when you have paid for goods or services, but you have not received value for it. call it prepaid expenses. A good example, you may pay for 2 years rent, and at the end of year 1, you are preparing your accounts. So the rent for the year 2, which you have not enjoyed, will come under prepaid expenses. Investment, any investments that has maturity within 12 months will have to be classified under current assets. So take notes, any item that belongs to a business entity which can be converted to cash within 12 months is referred to as current assets. Then the non-current assets, they are those items or resources belonging to an entity which cannot be converted to cash within 1 year. In other words, any asset of an entity that is expected to live beyond 1 year, 1 accounting period, is referred to as non-current assets. A good example is land and building. If you have land and building, your business, such land and building will be classified as non-current assets. You have office equipment, such office equipment, because you expect the office equipment to live beyond 1 accounting year, it will be classified as non-current assets. If you have motor vehicle, the fact that you expect your motor vehicle to live beyond 1 accounting period, such motor vehicle will be treated as non-current assets. We have intangible assets. Intangible assets are identifiable non-monetary items without physical substance. Identifiable non-monetary items without physical substance. Simply put, any item that you have which helps you to generate revenue, but such item cannot be seen, felt, or touched, such item is classified as intangible assets. Example of intangible assets, you may have license, you may have paid for license, maybe a fishing license. And because you have paid for that fishing license, you cannot see, feel, or touch that fishing license. But that fishing license will help you in revenue generation for the business. So such license will be treated as an intangible asset. So that's for the asset section. Bear in mind that assets are subdivided into 2, current assets and non-current assets. For the current assets, they don't live up to 1 year, meaning they are expected to be converted to cash within 12 months. That's within 1 year. But for the non-current assets, they can live beyond 1 year. Now let's go to the right-hand section. The right-hand section is made up of liabilities and equity. Liabilities and equity. Under the liabilities, we have current liabilities and the non-current liabilities. Current liabilities, in fact, liabilities generally represent any amount that you have to owe third party, any amount that the company owes outsiders. That's what we refer to as liability. So the amount you owe outsiders can be further classified into those that are expected to be settled within 12 months and those that can be settled after 12 months. So if you owe, take for instance, accounts payable under the current liability, maybe you bought goods on credit, that's accounts payable, trade creditors. For the fact that you're expected to settle those trade creditors within 12 months, they will be classified as current liabilities. Notes payables, maybe you have a loan, a short-term loan that you're expected to make payments within 12 months. Such notes payable will be classified as current liabilities. You have accrued expenses. You have received goods or services, but you have not paid for it. Such accrued expenses will be classified as current liability. You have deferred revenue. Deferred revenue, you have collected money from customer, but you have not discharged the performance obligation. It is a liability to you. It's a liability to you, and it will come under current liability. Then under the non-current liabilities, any amount or indebtedness that you owe outsiders, which cannot be settled within 12 months, will have to come under non-current liability. A good example, the NISA microfinance loan. If you succeed in obtaining the NISA microfinance loan, such loan, because you expected to settle it over a period above 1 year, such loan will be treated as non-current liability. Non-current liability. Then after liability, we move on to equity. Equity is any amount, any balances belonging to shareholders, capital contributions by shareholders. A good example is ordinary share capital, the amount of share capital that has been contributed by the owners of the business, that's the shareholders, and all accumulated retained profit or loss over the years. Those are equity items. So I want you to look at the total, the balances, the balance for the left column and the right column. Discover that the total asset is equal to the total liabilities and equities put together. It must be equal. The balance sheet must always be balanced. The two sides, two sections must be balanced. Now here is a typical example of income statements. For the income statements, we have the sales. All sales activities are aggregated. If you have various activities that generated sales income for you, it's expected that you itemize them one after the other. As we can see, we see client service revenue, book sales, professional consultation, and the rest. Likewise, if you are involved in farming activity, and maybe you farm various crops, or you are engaged in various farm segments, it's expected that you, at least while preparing your account, list those farm segments that you engaged in. You may say, okay, revenue from crop cultivation, revenue from animal cultivation, revenue from tractor hiring. So it's expected that you show the sources of your revenue, sources of your sales, how your sales were generated over the period. Then expenditures, all expenditures you incur during the year, you itemize them. Like we can see on the screen, we have wages and salaries, marketing and advertising, rent, utility, membership, insurance, consultation, and the right. So all expenditures, you aggregate them. And when you aggregate expenditure, you aggregate your sales, you deduct your expenses from your sales. It's expected that the sales should be greater than your expenses for you to be adjusted to be making profits. Any attempt for expenditure to outweigh your sales, it means the company has recorded losses for that period. And as you can see on the screen, you see that we have revenue figures, we have income figures for 2014, we have expenditure figures for the same 2014. And we also have figures for 2003 and 2004. 2004 is the most current year, and 2003 is what we refer to as the comparative year. Comparative year. So while preparing accounts, your income statement, is advisable that you present the current year, which in this case is 2004, and you also present the comparative year as a prior year, which is 2003. This will help users of financial information to make adequate, predictive, and informed decision. Anybody who looks at these statements, seeing the current year and the prior year, will want to see if the business has done fairly well this year or not. The person will look at results for 2003, that's last year, and results for 2004. We want to see if revenue grew or declined, and if profits grew or declined. So that's the main essence of providing the comparative figure to enable comparability of financial information. So here are components of accounts. Basic unit of accounting is an account or general ledger account. It is a unit of information that represents business records. There are 5 types of accounts. Every account, every financial statement that is prepared is made up of any of these 5 items: assets, liability, equity, revenue, and expenditure. In preparing the balance sheets, we use the first 3 components in preparing the balance sheet. That is the asset, liability, and equity in preparing our balance sheets. When preparing income statements, use the last 2, which is revenue and expenses, in preparing the income statement. So no matter the account you prepare, it must comprise any of these 5 components. No matter the accounts you prepare, the components of those accounts must be made up of any of these 5 components. Accounting, like we have said, is the process of recording business activities that make changes to accounts. This will include when sales of products are made, you book your accounting transaction. When you earn revenue from services, you book your accounting transactions. When you buy products or services, you also book accounting transaction. When you incur the expenses, you book transaction. When you depreciate your assets, you also book your accounting transaction. Recall that we said there are 2 methods of accounting available to bookkeepers. We have the single entry bookkeeping method, which I said will appeal mostly to those who do not have accounting background. And we have the double entry bookkeeping, which is more suitable for those with accounting background because we deal with debit and credit. So any transaction, any entry that is made, you must identify which of the accounts to be affected. But if you don't have accounting background, like I said, you may just maintain the books on a hardcover notebook, analysis, cash analysis column book, and the rest, or even in your check stubs. These are also simplified ways of maintaining your financial records. Double entry. I don't want to bore you with double entry because I know some of us may not have accounting background, but for every account that is debited, another account is credited. And let me take you back to these 5 components of accounts. Among these 5 components of accounts, some of them by default have debit entry. Some of them have debit entry. Assets and expenditure have debit entry. As the first and the last among these 5 have debit entry by default. For the trial balance rule, they have debit entry. Meaning, if I want the account to grow, if I want my assets or my expenditure to increase because it has a debit entry, I will debit these accounts. But if I want it to reduce in value, I will credit them. So the 3 in the middle, that's liability, equity, and revenue, they have credit balances by default. Credit balances by default, meaning if I want my liability to increase in value, I will credit it because they already have a credit default balance. If I want my liability to reduce because it already has a credit default entry, now I want it to reduce, I will debit that liability. But like I said, I don't want to bore you with this debit and credit because emphasis here is on bookkeeping and financial planning. It's just for us to know which accounts to always adjust when we're keeping our books of accounts. But remember, we said if the double entry bookkeeping will become a nightmare, will be a nightmare to us, we are advised to use the single entry bookkeeping method. So on this note, I would like to end the class here. And the floor is now open for questions, comments, or observations. So if you have questions, I expect you to indicate by a show of hand. Any question? Any question?
Hello, sir.
Okay, yes.
Morning, sir.
Good morning, sir.
Thank you. Yes, sir. Thank you. We enjoyed the lecture so well.
Thank you very much. Who is speaking?
This is Ode Emmanuel from Oju.
Okay, Ode. Okay.
Yes, sir. Now, please, I like to request that this lecture be downloaded for us in the YouTube, and equally the note be downloaded for us, because yesterday we took a business law, and up to the moment we cannot get the lecture notes. The previous ones we were receiving them. So if it is possible, short pen I think is better than long memory. The lecture is so interesting, but I like to have it downloaded so that we can be going through. Thank you, sir.
Okay, thank you. It will be posted.
All right, sir.
After the lecture, we'll make sure that it's posted.
All right,
Both the link, yes, the link and the material. So any question? Okay. Mr. Samuel Chinda.
Yes. Mine is not a question, but to
Observation.
really tell you that your lecture has been very, very interesting, and it has enriched me greatly, because as a businessman, there are things which I did not know, or I have a fair knowledge over it. Now my knowledge has been broadened. It's very interesting, and I thank you very much.
Thank you very much.
The lecture notes will be appreciated, is given to us as well.
Thank you very much. We'll send the lecture notes to you as well. We'll send the lecture note as well.
How you send the lecture notes?
Send the lecture notes. So
you print it out now.
Any more question?
No, I don't know how they can jot down on your own lecture notes.
Mr. Bayo. Bayo hand is up. Bayo Adisa.
Huh?
Mr. Bayo, you can unmute. Bayo Adisa, you can unmute. Mr. Bayo Adisa.
Hello, can you hear me now?
Okay, we can hear you now. Go ahead.
Thank you for the lecture. We enjoy it. However, I would suggest if you can get the hard copy, so that we can be going through it at any point in time.
We can't promise you hard copy, but soft copy, yes, we'll send it to you immediately after the classes.
All right. Okay. Thank you very much.
All right, sir.
Thank you.
So any more question? If there is none, let's quickly make attempts or a quiz, post-lecture quiz. You posted the quiz. Okay, so we are posting the lecture quiz, and you're expected to attempt it within 10 minutes. Lecture quiz will be posted so that exactly 12 p.m. we'll end the class for today. Have you? Okay, so the lecture quiz has been posted. Lecture quiz has been posted at the WhatsApp group. So you're expected to take expected to make attempts within the next 10 minutes and return back your answers. So you are not expected to leave. You are not expected to leave. Don't leave. I see some people are leaving. Don't leave. Finish up your quiz.
But,
then we conclude the class for today.
excuse me.
Yes, sir.
Yes, I tried to download the. I answered one at the beginning of the class.
Yes, that's pre-lecture quiz.
So
that's the pre.
Yeah, the pre. So I'm clicking on the recent one that has been sent now, and it's still telling me this.
Okay, I said you should refresh your browser. Refresh your browser, yes, from what I was told. Refresh your browser.
Okay, yes, I've got it now. I've gotten it. Okay.
All right.
Thank you.
So nobody must leave. I'm looking at all of you. Nobody has left. Okay. Hello, everyone. I see that most of you have turned in your answers, and the performance is quite impressive. Some of you even scored 100 over 100, some 80, some 90. So it shows that at least you clearly understood what was taught. And me, the lecturer or the facilitator, I'm so happy that you're able to demonstrate you understand what you have been taught. So I urge you to keep it up in that manner. For those of you who are yet to turn in your answers, I will advise you to do so. I think you have 24 hours now to turn your answers in. So you can do that even after the classes have come to an end. So on this note, I want to thank all of you, at least for your attention. As well, wish you happy Eid Maulud, especially to our Muslim brethren among us. So happy Eid Maulud, and to the rest of us, happy holidays. So on this note, we'd like to end the class. The class will come to an end. Watch tomorrow, same time, 10 a.m. for the next lecture. So thank you once again. You enjoy your holiday. Bye for now.